Good afternoon, everyone. This is Brian Shannon from AlphaTrends.net. Today is Friday, May 3rd, 2013, and the market's closed for the week. Let's take a look here. It's said that news and surprises tend to follow the direction of the primary trend, and I think it was certainly a surprise to not only the bearish participants in this market, but for a lot of the trend traders as well, that we had such a strong market this week. Let's take a look at the numbers here. The S&P 500 finished the week with a gain of 1.98%, and for the month we are now up after struggling on the 1st of May when a lot of people were repeating the phrase sell in May and go away. The NASDAQ for the week was up 3.6% and semiconductors 3.8%. So big week for equities once again as the primary trends continue to show us that it pays to follow them. The bonds got hit a little bit. We'll talk about them as well here today. But the S&P 500, we came into the week saying that, a lot of people were complaining about the volume of this rally. Well, I've been pointing it out for the last several years that in the indexes, the volume really doesn't seem to take on as much significance as it once did. For individual equities, I think it's a lot different, but if you look at all of these rallies, the trend during these rallies has been for lower volume. That's a consistent message that's been in place since 2009. So don't pay attention to the things that the media necessarily is telling you to pay attention to. Don't pay attention to the news headlines. Instead, pay attention to the one thing that's going to put money in your pocket at the end of the day, and that is price action. Price action can hurt you. Price action is the only thing that will make you money, though. And for this week, obviously, it was a very bullish week. We saw that little pullback on Wednesday, I guess it was, and we held above what we were saying was going to be the key level of support for this week, down near about this 157.5 level. And I had during the week, I had told subscribers on Wednesday that I thought this was going to be the important level. Now what we want to see for the S&P 500 is that we remain above about 159.5. It's very easy to say this market's extended. Anyone can see that. I've been saying that it doesn't make sense to chase a market that's been up, but we did digest these gains, and then the news came, and it took a lot of courage or bravery or maybe even stupidity to buy yesterday. But knowing that the jobs report was going to come out like this, but for those that did, were rewarded for paying attention to the trend. Now you have to do what's appropriate for you, obviously, but I don't think that selling short makes sense during a primary uptrend. The only time I would defer from that opinion is during the intraday. If we're below a declining volume weighted average price, then there will be times for day trades only. But when the primary trend is higher, mathematically we have to have higher highs and higher lows. That's the way it works. Your better odds for making money are always going to be by going long. We've held the bigger level of support. We saw that a couple weeks ago. There were a lot of people that said this market's done because it closed below the 50-day moving average. One knucklehead on television said it was in a downtrend, and here we are, 5% higher or so. The fact is, again, pay attention to price action. This gives us reason for warning when it closes below the 50-day moving average. But the fact that the 50-day moving average is advancing takes precedence over that, and the prudent course of action is to not sell short there, especially after the decline has taken, but instead to let the action unfold, study it as we did, and then decide to get bullish and trickle back in as the market dictates. There's nothing wrong with being cautious during a pullback in an uptrend, but these 2 to 3% pullbacks have been just that. No one has called the top correctly in any of these markets. The NASDAQ continued to move higher also. We've got this longer term trend line that it's riding on the weekly time frame. We were thinking that a couple weeks ago perhaps we're going to see that become jeopardized. However, we continue to move higher, and this NASDAQ, we've got the possibility that it could be heading up towards $80. Now, I don't think that's going to happen right away, or that it's something that we realistically need to think about at this time, but the path of least resistance is higher. What we need to focus on is maintaining our discipline and paying attention to what matters. Again, that's price. Yesterday I pointed out, where would your stop go? Under which one of these higher lows is up to you? Well, now I would say here we have another higher low on an intraday basis if you've been involved for maybe the last week or two. The path of least resistance, again, is higher. I know I repeat myself on this, but you wouldn't believe how many times I get antagonistic emails and chats and that sort of thing that say that I'm wrong and that it's going to end badly. It's only going to end badly for people who don't have the discipline to get out. If you're looking for a consistent methodology, one that's based on price action, consider a subscription to Alpha Trends. There's 3 different plans there. I will let you take a look at that yourself instead of being an infomercial. The NASDAQ, however, is extended here, but that doesn't mean it has to come down. Next week, I would expect some pullback in here. The bigger level of support is down all the way at $70. For now, I'd say we'd want to stay focused on about 71 and a quarter, where that rising 5-day moving average is likely to be met early on. To pull back down towards that level would not come as a surprise whatsoever. The Russell 2000, I said on Thursday that I thought it was in a range. Today, we broke through the high end of that range. And again, do you want to be the person that buys this new high up in here after we've seen such a big rally? I don't think so. If you do, well then, make sure you know where your stop is. But we survived this little pullback to 91.5. That was our key level that we wanted to see after Wednesday, and now we're back to higher highs and higher lows. Let's see how the market handles about 94 next week. That would be our first level that we want to see hold as support. We are up at all-time highs here in this at Russell 2000. So the trend continues to be your friend. Fight it, and unfortunately, you're going to get what you deserve, in my opinion, for fighting trends, which is you deserve to lose your money for thinking that you're smarter than the market is overall. The semiconductors had a great week. They continue to get extended beyond this breakout at 36. As I said, I wouldn't be a buyer of that breakout past 36, but if you were a buyer, that's great. Nice trade in there. I said that if you wanted to raise your stops above these higher lows, and the level we were looking at this week to hold was that 36 level. We held that, and now I think that this is going to be an important level where we saw a little bit of support on Wednesday and Thursday at about 36.80, but definitely do keep an eye on that 5-day moving average. We're getting extended. We're due for a pullback, but you could have said that here, and here. The fact is we're at multiple year highs. We broke past the 2011 highs, and when we look back a little bit further, and what we can do is just draw a horizontal line as far as where we are, and here's where we have the potential to go, perhaps, is up near 39.40. Again, I think that's an aggressive target, and it likely won't happen on this run, but we have to look at it and say that's definitely a possibility. The buyers are in control here, and the reasons that they're buying don't matter. The fact is people are buying. Money is flowing into U.S. equities. Fight it all you want, but the financials are continuing to work themselves up towards that $20 level that we've been focused on for the last 4 or 5 months. And will they make it on this run? Probably not, but the fact is we held above key levels of support in here. We were talking about 1840 to 1850 this week, and the market broke out again here today. This is why you don't sell short in a primary uptrend, because the consolidations through time tend to get resolved in the direction of the primary trend. Next week, what we'll want to see is about this 1870 level hold as an area of support for the market. Gold is still in a downtrend. It's experiencing a bounce, but it's still in a primary downtrend. If you look at this weekly chart, we could still bounce back up towards 148 even, but it's a broken asset right now, and it's getting a bounce, which is what they do. The bonds got hit pretty hard today, down $2.92, so yields were up, and looks like this area, the 120-ish area ought to become support for that market. Let's take a look at Apple finally. Apple had a big week here the last 2 weeks since their earnings. The stock is up pretty significantly here. If you look intraday, we're up from about 385 to 450, and this is the level that we've been kind of focused on as far as potential resistance. First, let me say we were looking at this level, the 435. Well, we broke beyond 435. 435 was tested. It held as support, and we've seen further strength from there. But now where we are is we're right up against the level that's been providing a resistance for this market pretty much every bounce this year. which is the volume weighted average price. This calculates the volume weighted average price since the beginning of the year through today. So you can see all the times that it's tested that volume weighted average price for the year and it sold off. Now, we've had a big run, so where has it come from? 385 to 350. Where does it have the potential to go before it's likely to encounter supply? Well, it seems like this volume weighted average price since the event, and the event being January 1st, is clearly a level that we should be aware of. It doesn't say that Apple is declining because we're still showing, even on this 10-minute time frame, higher highs and higher lows. So we want to be aware that it's at an important level. We do have a declining 50-day moving average and another pullback down towards that 50-day moving average, or even down towards the 10 and 20-day moving average, I think would be good for Apple. So don't be chasing this thing. You'll end up regretting it, I believe. Despite, you can say, well, Apple's going to be buying back this many shares. They're not going to do it all in the next week. You have time. They're going to be smart about it as well. They're going to have consultants that tell them that the market will pull back. If Apple wants me to work for them, shoot me an email. I'll look at your resume and I'd be happy to help you with your repurchase. Anyways, don't chase it. Look for it to pull back, and perhaps Apple is beginning its bottoming process. There's no evidence of a bottom at all. There's evidence that perhaps we're seeing a bottoming process, but as we've observed, we've seen these types of breakouts. Or breakdowns rather, that get a sharp rally and then they have failed. This one is still guilty till proven innocent. I realize a lot of people have hope in Apple, but hope is not a strategy to trade on. Look at the objective price information, and if you're going to trade the stock and try to invest in it for the longer term, make smart purchases. Don't get excited as it rallies like it has.